Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Today we have a tremendous treat in store for our listeners as we welcome in none other than Steve Forbes. I had the honor of sitting down with Mr. Forbes earlier this week and got his insights on the presidential election, the importance of owning gold, and why he believes the time is now for American politicians and voters alike to bring back a gold-backed currency to help restore our out-of-control monetary system. So stick around for an interview you simply do not want to miss with Steve Forbes, the two-time presidential candidate and CEO of a multimedia empire. Once again, the big news in the markets this week, unfortunately, was the Federal Reserve's monthly policy decision. And of course, market players and commentators tried to one-up the central bank by anticipating which specific words policymakers would or wouldn't include in their statement. After the statement was released, markets gyrated as everyone rushed to try to capitalize on the Fed's announcement. The Fed decided to leave its benchmark funds rate unchanged for now. No rate hike was expected this month, but stock market bulls had hoped the Fed would also take a rate hike off the table for March and beyond. That didn't happen. So in the coming weeks, the financial media will obsess about when the Fed might raise next. Former Dallas Fed President Richard Fisher admitted in a recent CNBC interview that the Fed had front-loaded a stock market rally with its quantitative easing program. Fisher expressed concern that investors became obsessed with the Fed and its stimulus instead of fundamental analysis. Now he warns that the Fed has, quote, no ammunition left. If investors come to believe that the Fed will no longer support equities, then the stock market could see much lower levels. However, it's worth pointing out that former Fed Chair Ben Bernanke would disagree with the notion that the Fed is out of ammunition. He indicated that the Fed could very well move to negative interest rates in order to fight a recession and stimulate markets. To be clear, negative interest rates means you pay the bank for holding your money, not the other way around. In any event, one of the best performing assets since the Fed moved to hike short-term rates by a quarter point has been gold. Since the Fed's December 16th hike, gold has risen by more than 5%. By contrast, the Dow Jones Industrials has fallen by 8%. This week, gold is again showing strength versus the stock market. Gold prices rallied strongly into the Federal Open Market Committee announcement on Wednesday. The yellow metal gave back some of its gains on Thursday. As of this Friday morning recording, gold prices come in at $1,118 an ounce, good for a 1.8% weekly gain. Platinum, which has fared poorly compared to gold in recent months, is faring better this week. Prices are up 5% in a wild week of trading for the industrial metal, which now comes in at $875 an ounce. Sister metal palladium is advancing today, but is little changed on the week and currently trades at $501. Silver, meanwhile, shows a weekly advance of 1.6%, with prices now trading at $14.29 per ounce. Silver prices are up modestly so far this year, but there's nothing modest about the extraordinary developments we're seeing in the silver coin market. Demand for Silver Eagles appears headed for a record January after Silver Eagles sales set multiple records last year. Sales of Silver Eagles are normally strong in January. The release of the coins with the new year minted on them always attracts buyers. But this January, the U.S. Mint has been unable to keep up with demand, selling out of its weekly allotments and implementing rationing measures. Authorized purchasers are also being limited on how many they can buy each week. Curiously, general retail demand for Silver Eagles and any other form of physical silver is not high at the moment, begging the question of who is actually snapping up all of these Silver Eagles. But one thing is for sure, the domestic supply and demand situation for physical silver has never been more out of whack as it has been in the past 9 months. The paper price-setting markets seem oblivious. But underneath the surface, the silver and gold futures exchanges are experiencing a supply crunch of their own. Registered gold inventories on the COMEX have fallen to their lowest level in more than 20 years. There's a decent chance that something will break in the futures market this year, and if something like a physical default occurs, the lid on gold and silver prices could get blown clear off. In the meantime, long-term investors should remain focused on the fundamentals for physical gold and silver and not get deterred by paper market manipulators or intimidated by the Federal Reserve's next action or inaction. And now, without further delay, let's get right to this week's exclusive interview. It is my great privilege now to be joined by Steve Forbes, editor-in-chief of Forbes magazine, CEO of Forbes Inc., and author of many fabulous books, including Flat Tax Revolution, How Capitalism Will Save Us, and his latest work, Reviving America, How Repealing Obamacare, Replacing the Tax Code, and Reforming the Fed will restore hope and prosperity. He's also a two-time presidential candidate, having run in the Republican primaries in both 1996 and 2000, and it's a tremendous honor to have him on with us today. Mr. Forbes, thank you so much for joining us, and welcome.
Well, good to be with you, Mike. Thank you.
Well, there's so much I want to ask you about, and I know time is quite limited here, so I'll get right into it. I want to start out by getting your take on the 2016 presidential election cycle, especially given your firsthand experience in the whole process. Now we're seeing an anti-Washington voter result of sorts. It's the anti-establishment candidates that have been getting all the momentum. This is especially true on the Republican side, where we see an outsider like Donald Trump currently leading, and guys like Ted Cruz, Ben Carson, and others having garnered a lot of support. But also on the Democratic side, we're seeing admitted socialist Bernie Sanders starting to overtake Hillary Clinton with his outsider bid. So what's driving this phenomenon, and is this a good thing or a bad thing?
Well, what it demonstrates is intense, deep voter dissatisfaction with where the country is and fears about the future. There's contempt for the political class for not being able to handle things. There's the feeling that those who are in charge either don't know what to do, or if they do, they don't know how to do it. So people are looking for outsiders for a fresh perspective. Just as in business where incumbents get too comfortable, you always find entrepreneurial outsiders to challenge the status quo and upend things. You're seeing the same thing happening on the political side. So who knows if Trump will go all the way, how far Bernie Sanders will go, but it's a way of, at least for now, voters expressing dissatisfaction, unhappiness, and saying, we want positive change. You cannot continue doing what you're doing.
The issue of sound money has been getting more attention during the GOP debates than it has in several decades. It's quite encouraging to hear Cruz, Paul, Carson, and even Trump bring up issues related to sound money, such as reining in the Federal Reserve, returning to some sort of a gold standard, and other measures to get America's fiscal house back in order. I'm guessing you probably felt like a lone voice in the wilderness when you raised these subjects during your presidential runs. So among the current candidates, who do you think best understands the problems created by our current monetary policy and might actually do something about it if elected president?
Well, I think it's encouraging that a growing number are recognizing there is a problem. Even before you get to solutions, you got to recognize and acknowledge that the way things are being done is not working. And the Federal Reserve has been a huge factor in the sluggishness of the U.S. economy. Very, very destructive actions they've taken. So I was delighted that Ted Cruz in one of the debates brought up the idea of a gold standard. Rand Paul, of course, was suckled on the idea of safe and sound money. Ben Carson's made reference to it, and Donald Trump has made noises about the Federal Reserve. So I think that's a good sign. And one of the things that really most of the economics profession doesn't seem to get is that money is simply a means of for us to buy and sell with each other. It's like a claim check. You know, you go to a restaurant, check your coat. The claim check has no intrinsic value, but it's a claim on the coat. Money is a claim on products and services. It has no intrinsic value. What it does is like a claim check on products and services, and it works best when it has a fixed value. Money measures value the way, say, scales measure weight or clocks measure time, or rulers measure space and length, and it works best when it's stable. And the best way to get stable money, as we explain in our book, Reviving America, is precisely to link it to gold the way we did for 180 years. It works. Gold is like a ruler, has a stable value. When you see the price fluctuate, that means that it's the dollar's value that's fluctuating. People's feeling about it for the present and for the future. But gold is like Polaris, the North Star. It's fixed.
That leads me right into my next question here. About a year ago, you and Elizabeth Ames co-wrote the book titled Money, How the Destruction of the Dollar Threatens the Global Economy and What We Can Do About It. You proposed a modified gold standard, and I'll quote here, and then I'd like to get your comments. The 21st century gold standard would fix the dollar to gold at a particular price. The Federal Reserve would use its tools, primarily open market operations, to keep the value of the dollar tied at that rate of gold. So what would be the main benefits of such a reform? And also I'm curious why you stopped short of calling for an end to the Fed altogether and a return to true free markets when it comes to gold and the rate of interest.
Well, in terms of the role of the Federal Reserve, I think you've got to take one step at a time. One of the fears is that if you didn't have the Fed, when you get a panic, which happens for whatever reason every few years, the thing would spin out of control. And so I think the key thing now is to get the dollar fixed in value, which we propose in that book, whether it's $1,000 an ounce or $1,100 an ounce. I think the best way to understand this is to imagine what would happen if the Federal Reserve was in charge of the Time Bureau and the Fed decides to float the clock, 60 minutes an hour one day, 35 minutes the day after, 90 minutes the day after that. Everyone would know that if you had a fluctuating clock, if your timepieces couldn't keep accurate time, life would be chaotic. And the same is true of money when it has a floating value. And if you had the floating clock, imagine baking a cake. It says bake the batter 30 minutes. Now, is that inflation-adjusted minutes, the nominal minutes, a New York minute, a Mexican minute? And so we got to get them. And gold is the best way to fix that value. And the only role for the Fed, at least for now, would be to keep that fixed value and then deal decisively with the occasional panic, just as the British showed us how to do 150 years ago. If you have a panic where banks need temporary liquidity, they'd go to the Fed with their collateral, borrow the money at an above-market interest rate, and then as the crisis recedes, they'd quickly pay it back, and it's done. So the Fed's role could almost be done by summer interns if they knew what they were doing. And so there would not be the monster that it is today, where the Fed tries to dictate where credit goes, what happens to the economy. It's really bizarre and destructive.
They certainly have a whole lot of control, and a lot of people have a lot of interest in Fed policy, way too much for our liking, and I'm sure yours as well.
Just one other example on them is, if Janet Yellen says, the head of the Federal Reserve says that we should have 2% inflation, which in her mind means prices rising 2% a year. If you take a typical American family making $50,000 a year, that means their costs would go up $1,000 a year, 2% of $50,000. Who gave her the authority to raise the cost of living, which is in effect a tax, $1,000 on a typical American family? And yet in Congress they just nod their heads. It's a travesty.
And I've always wondered if 2% is good, isn't 3% better? And what about 4%? It seems like it could just go on and get higher and higher.
Yep, which is what happens. But an unstable dollar, whether it's weak or strong, is like a timepiece, a watch that is too slow or too fast. Neither one is going to help you.
Well, the equity markets have been quite volatile here in the early part of 2016, and a lot of that seems to stem from these overvaluations we were starting to see. Do you believe the recent pullback is just a short-term market cleansing, or do you expect a bigger, more dramatic event to occur with this just being the tip of the iceberg?
Well, when you get a big change in the stock market, it's usually because of a surprise. People talk about oil, people talk about China, the pressure on earnings. Those things are already known. And so it's the unknowns that hit you. And I think one of the things that has hit the markets, and they can't be able to know the exact consequences, is precisely what's happening in our politics. The idea of Bernie Sanders winning is still remote, but now you can't rule out the possibility. What does Donald Trump want to do about trade? Well, he's been all over the map, to be blunt about that. He says he'll negotiate it, but that kind of uncertainty, people stay on the sideline.
Looking at the current economic landscape and the debt-based dominated markets that we have now, a situation that appears to have only worsened since the '08 financial crisis, how do you envision this playing out? Are we looking at some kind of economic collapse again, or will the Fed and the central planners be able to keep the wheels on this thing?
Well, those words central planners gets to the problem with the Fed. The idea that the economy is a machine is a preposterous one. The economy is individuals. And the idea that you can control people the way you can modulate an automobile is that's how you get tyranny. That's why in the third part of our book, Reviving America, we talk about Soviet-style behavior by the Federal Reserve and by economic policymakers. So when you look at the great disasters of the past, like the Great Depression, the terrible inflation of the 1970s, what happened to us in the panic in 2008, 2009, all of those had at their roots disastrous government policy errors.
I want to talk to you about the role that gold and to some extent silver can play into all of this. Now, in your book, you've written about gold and its role in an investor's portfolio, but that we shouldn't necessarily look at it as a, quote, investment. Talk about that, and then also whether you view gold ownership as more or less important now versus, say, 10, 20, or 30 years ago.
Well, in terms of, unless you're a jeweler, gold is, I see it as an insurance policy. It doesn't build new factories or things like that, new software. But what it is insurance that if things really go wrong, you've got something that'll balance your portfolio. So whether it's 5%, 10%, it shouldn't be dominating your portfolio. But since you cannot trust, at least right now, what politicians do, what you have working out here is a situation where, yes, the price of gold has come down since 2011, when it looked like the U.S. government might default. But today, in this kind of environment, is probably a good time. Not that you're going to make quick money on it, but it's like an insurance policy. You hope it doesn't have to be used, but if it does, you've got it.
Obviously, we talked about how the anti-establishment is maybe starting to get some momentum. Do you see any real change coming about in our monetary system without some kind of crisis event forcing it? It generally seems that things don't change unless they're forced. What do you think is now maybe the time in Washington for some of these politicians to seize on the fact that a lot of Americans are very frustrated and maybe there is the ability to get some traction with some of these radical reforms and getting us back to something that maybe relates to sound money?
Well, this is why one of the reasons why we did the book was to lay out what needs to be done so that if the opportunity or the crisis arises, we have the tools to do it. We had this terrible crisis in 2008, 2009, but because policymakers were still holding these obsolete theories and the dangerous notions about money, which got us in the crisis in the first place, they not only made mistakes, they invented new mistakes, such as quantitative easing or zero interest rates. Zero interest rates sounds great, like price controls sound great. You're in an apartment, you only pay $10 a month. Boy, that sounds great if you don't mind having no maintenance. But when you suppress prices, you will you distort the marketplace, deform the marketplace. People don't invest, and you get stagnation. The Federal Reserve announced that it was going to put price controls on Big Macs at McDonald's and what you pay for a rent-a-car and things like that. People would say that's outrageous, but then the Fed would say, well, we want to suppress prices to stimulate the economy so you have more money to spend. Well, we know it would just wreck the economy. Yet when they do the same thing with interest rates, people don't, Congress hardly says a poo. And the Fed has distorted markets to the point where on zero interest rates, what the Fed in effect did was seize almost $4 trillion of assets out of our economy made it very easy for those assets to go to the government and to large companies, and starved credit to small and new businesses. Just one statistic, in the last 5 years, the growth of credit to government has gone up 37%, growth of credit to corporations 32%, growth of credit to small businesses and households only 6%. And as you know, small and new enterprises are where the bulk of the jobs are created. So the Fed's in the business of credit allocation. That is profoundly wrong and must be changed.
We're talking here in advance of the January Fed meeting. By the time this interview will air, that decision will be known. But just more generally speaking, where do you see Fed policy going here? Are they truly stuck between a rock and a hard place? And what do you think their policies are going to be as we go throughout the year?
Well, they'll be tempted to stop allowing market interest rates in the name of saving the economy, which is like taking an anemic patient, a patient suffering from anemia, and bleeding them. The Fed should just, the rock and a hard place is only in their minds. What they should do is just step aside, let borrower and lender determine what interest rates should be, and let markets function again, instead of trying to control them like commissars in the old Soviet Union. Free markets always work when you let them, but the Fed has to be pushed on that.
Well, as we begin to close here, what do you think it's going to take for gold and silver to become a mainstream asset class again? For example, will it be China or Russia backing its currency with precious metals because the devaluation has gone too far, too fast, something like that? What are your thoughts there as we wrap up?
Well, I think that if they see precious metals for what their historic role has been, we would have gold-based money, gold-backed money today. Remember, gold is a ruler. Because it's got that fixed value, it makes sure that the politicians don't muck around with the integrity of the U.S. dollar. We had a gold standard from the 1790s right through the 1970s, 180 years, and it worked very well. We had the most phenomenal growth of any country in the history of the world. And since then, we've had more financial crises, more dangerous banking crises, slower economic growth, and we see the stagnation that we have today. So maybe the Russians will get it, maybe the Chinese will get it, but the reason we have this book, Reviving America, is to help activist citizens have the tools they need to push to get integrity back to the U.S. dollar, get rid of this horrific tax code, and get patients in charge of health care again. And we do those things, and you'll see the American economy roar off like a rocket. You should have your gold as that insurance policy, and life will be good again.
Well, Mr. Forbes, I can't thank you enough for your fantastic insights and for being so generous with your time. I very much enjoyed reading your latest book in advance of this interview. You give the reader a great explanation of the history behind all of this, and then also, more importantly, some practical things that they can do to protect themselves. And we certainly urge everyone to check that out. And it was great speaking with you today, and we wish you and your family and your team there at Forbes and Forbes.com all the best. Thank you so much, and thank you for your continued efforts to spread the ideals of free market and liberty. It's been a real pleasure to talk with you.
Great pleasure to talk with you, and don't lose faith. Markets are people, and people thrive most when they are free.
Excellent way to end, and that'll do it for this week. Thanks again to Steve Forbes, CEO of Forbes, Inc., editor-in-chief of Forbes magazine, and best-selling author, including his latest work, Reviving America, How Repealing Obamacare, Replacing the Tax Code, and Reforming the Fed will Restore Hope and Prosperity. You can obtain a copy of your own at Amazon.com, download it onto your Kindle or iPad, or purchase it at other places where books are sold. And don't forget to check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.